Hey, what's up, everybody? Hope you enjoyed your day off. Sometimes it's good to have some time off, man. Get a little space from the market. We get too wrapped up, too micro focused, right? Just looking at prices changing back and forth all day long. So we're gonna go into this week. Hopefully things start calming down. I mean, we had the Fed last week, 75 basis points. Economy now just really in a stall, I would say. The one thing we've had almost back to back, April, part of May, and then again last week. I mean, we have had a series of very big tax related liquidity drains. I've been talking to you guys about that. April, 323 billion. Government ran a big surplus in April. The surplus went right into May, all the way through May 13th. We finally started to get some positive fiscal flow. The deficit built back up. That was good. The market started to stabilize. And then last week we had another 107 billion drain with the quarterly corporate tax payments. I mean, it's just really hard to get any upside momentum when you're constantly having these tax drains. And it just shows you right now that spending may not be, as much as I talk about the flows being, 30% higher than what they were in the pre-pandemic. I mean, taxes are just eating all that up. We saw again another 100 billion drop in the deficit. It went from like 827 billion down to 717 billion last week. I mean, at this time, that's almost 1.5 trillion below where we were at this time last year. I mean, that's a big, that's a big drain. You want to know why personal savings are down so much? I mean, that's it. The government is just sucking it up in taxes, and they're not recycling it back out as fast as they were over the last 2 years. Now, comparatively, and this is the point I've been trying to make, that comparatively, when you look at it relative to pre-pandemic, right? Because we got really spoiled with the pandemic when they were pumping in, 3 trillion for 2 years straight. I mean, 3 trillion on a nominal basis, that's bigger than anything. That's bigger than World War II. It's not bigger as a percentage of GDP, but on a nominal basis, just that number, that's like bigger than World War II in the last 2 years. So, I mean, the economy got pumped up on that, and the stock market got pumped up on that. But, what I've been saying is that before the pandemic, when they were running at an 800 billion, a trillion deficit, I mean, that was fine. We saw a great stock market under Trump. But the deficit maybe is shrinking even below a trillion right now. I mean, it's a tough call. It looks like about a trillion one, but that doesn't seem to be enough right now. Especially given the inflation situation, and the inflation situation means, that's transfer to the foreign sector. So that, that income is flying out to the foreign sector. That's a subtraction from GDP. As a matter of fact, the biggest, if you look at first quarter negative GDP, most of that subtraction came from the trade deficit, came from that outflow of income to the foreign sector. And we're probably going to have that again, although we are seeing some significant improvement. In fact, what was it, in April, we saw the biggest 1 month contraction in the trade deficit ever. It was like I think it was like a 13 billion narrowing in April in 1 month. So that's helpful, but it's still huge. It's still huge. 87 billion. It was like 87 billion, a month. That's still huge. So we're right on the borderline now. I mean, if it wasn't for the inflation impact and the subtraction to growth that's causing, we'd probably have like what we had over the last, what, 13 years, annual average GDP growth of around 2.5%. We were doing that, running like 400 billion monthly fiscal flows. Now we're running like 550 to 600 billion monthly fiscal flows. So, we're like 30 to 50% higher. But unfortunately, it's the inflation, and that's what's hurting us. So we're right on the borderline now of zero growth, or maybe going down into negative, which would be, that's the widely held definition of a recession, is 2 consecutive quarters of negative growth. And the stock market is reflecting that. I always say that, this game is about figuring out what the economy is doing. If you figure out what the economy is doing, then you can get a pretty good handle on the stock market. So it's not surprising that we had this pullback in the stock market from the highs, because we went from fourth quarter of 2021 GDP growth of 7.5% down to like zero now. So yeah, you're gonna see that in the market. It's not some mysterious thing where, how do you tell where the market's gonna go? If the economy goes from 7.5% growth down to zero or negative, yeah, you're going to have a pullback in the stock market. It reflects that. There's nothing extraordinary about that. The question is, do we stabilize here, or does it get worse? And the way it would get worse would be if we start to see layoffs, if we start to see unemployment rise. Now, if you look at weekly unemployment claims, they're running about, 220,000. That's historically still very low. It's up a little bit from we did like a 60-year or a 65-year low. I think it was last month. We hit like 180,000 in new claims. Okay, now it's 220, but 220, a week, that's low. That's really low. So it still kind of indicates that the labor market is strong. The other thing that we're seeing too, or that I'm seeing, is that average daily unemployment benefits. In other words, how much is the government sending out every day? It's 88 million. 88 million it's nothing. We hit a low 2 weeks ago of 77 million. That was the lowest average daily unemployment benefits flow this entire fiscal year, and probably for multiple years. I just didn't go back over a whole bunch of years, but 77 million a day that the government's sending out. When you're talking about a government, spending 7 trillion annually, that's like, it tells you right there, that's like, is nothing, man. So it popped up a little bit to 88 million. If you think about it, last year it was like we were doing 1.5, they were sending out 1.5 billion a day. Okay, now we're down to 77, 80, 88 million. So it shows you that the labor market is still strong, but that doesn't have to remain that way. Consumer spending is still high. Look, I went over all the banking data, as I always do. By the way, today is Monday, even though it's a holiday. I did send out my report, MMT Trader. So if you want a copy of that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. The link is in the description here. The banking data still looks good. You got loans rising at the fastest rate in 2 years. That includes commercial and industrial loans. So it's in the industrial sector, you're starting to see firms. Now, a lot of people are saying, everyone's tapped out. Well, and I tried to explain this before. You have to still have a level of credit worthiness. It's one thing to say everybody's tapped out now on credit. That would not be the case. If that were true, you would not see the growth in loans accelerating. You would see that decelerating because you have to factor in credit worthiness. In other words, yeah, I walk into a bank, I say, I want a loan. Okay, fine, Mike. Let's see your financials. What's your income? How much debt do you have? You know, that's what's going to determine whether or not the bank is going to give me a loan. My credit worthiness. What's your FICO score? What's your credit score? That's what's going to determine. Now, if loans keep going up, it's a statement about credit worthiness. It's still very strong. If that were not true, you wouldn't see an acceleration in loan growth. The other thing is this: the only real constraint on a bank's ability to lend is its capital. So for loans to be increasing, it must suggest that the capital situation, the financial situation, the financial position of banks is very solid. Don't forget too that I talked about this a lot last week, and it's a point that has not been touched upon in the media or market analysts or pundits. The fact that this interest rate hike that the Fed just put through, we're at what, 1.5 to 1.75 on the Fed funds rate. The Fed is on the hook for paying interest on reserves. And we have 5.6 trillion in system reserves. That comes to about 90 billion. That's 90 billion that the Fed must pay. That gets paid into the economy as interest income. All right? Nobody's talking about that. I mean, that's a really significant fiscal boost. That's a significant fiscal boost. If you think about it, last year, those child tax credit payments, 6 months of those payments anyway, that was 90 billion. So that makes up right there for 6 months of those lost child tax credit payments. Now, it's not going to the same cohort, unfortunately. But, again, using the swimming pool analogy, it's going into the swimming pool. It'll end up being circulated around in one fashion or another, unevenly. I get it. I'd much rather have me personally that the, needy kids and families who need that money, that never should have been canceled. And by the way, Biden just approved, I think, an 820 billion new defense budget. And that doesn't even include the 53 billion or so that we're sending to Ukraine. We're not really sending them. It's going to like our military industrial intelligence complex. I mean, it's disgusting when you think about it. You cancel the child tax credit payments, but like this ever insatiable machine of the military industrial complex, the defense complex, the defense surveillance, whatever you want to call it. I mean, just the money they continue to demand more and more money, and it's just given and given and given. The worst possible way to conduct fiscal stimulus. Like, nobody's talking about, when people were getting some checks to help them out during the pandemic, everybody went crazy like, oh, that's so inflationary. But you're giving almost $1 trillion right now just in the defense budget. That doesn't include stuff that's like off budget, fighting wars, shit like that. You're way over $1 trillion. So that's going to be pumped in. The fiscal is solid. I'm just saying that taxes right now, that's the thing. Like, if we had a tax cut right now, the market would blow through the roof. It really would. But I have to say that the sanctions and what's happening. Oh, here's another thing. Because last week we had a pullback in oil prices. I looked again at the CFTC commitments of traders it was for the week ending June 14th. That was the week ending last Tuesday. Oil producers again on the buy side with futures, WTI futures. They were net buyers. It was the first, actually, it was the first time they were net buyers in 3 months. So they were buying that pullback. Very interesting. So, as I've been saying, I would not get bearish on oil until I see producers flip short, net short on crude futures. They've been long since November. So what was that, 8 months? They've been net long, which is that's a rarity. That's a rarity. I mean, these guys are producing the physical oil. Usually they're short. As long as we're talking futures and positions right now, I'll just let you know that gold producers, they were buyers last week. So were silver producers. They were buyers. Actually, silver, very aggressive buyers. I don't see gold and silver going down very much. These guys have been steady buyers. And as a matter of fact, swap dealers, those are the big Wall Street banks, they are net long the silver futures market, and that is also a rarity for them. They are net long the silver futures market, so take that into account. Anyway, that's it for today. Hope you enjoyed your day off, if you had one. If not, all right, keep on trucking. I'll see you tomorrow. Bye.